So happy Thursday, everyone. Here we are with the Paul Levine show. I'm Greg Dixon and Paul Levine and Betty Withrow. And today we're going to talk about multi-generational real estate and tax strategies. I think, Paul, you have a little scenario that you want to talk about.
I do, but before I get into that, I just want to mention one thing. The Fed met last week and they kept the interest rates at the same rates as they were. But they said that there would be 3 reductions before the end of this year. And those will probably come before November, because the way I look at it is if the interest rates don't come down significantly before the election, the Democrats won't even be able to get elected to dog catcher.
Yeah.
End of political state, and that has nothing to do with my politics. Now let's get to the multi-generational income tax strategy. There's something that's been around forever, and it's here, but I've never seen someone plan for it. And if you plan for it, you can get away without paying taxes on $1 million or more. Let's go through a situation. Now, I don't know how many of you know what a Section 1031 exchange is, but when you go out for the first time and you purchase a piece of commercial property, let's assume an apartment building, then it will appreciate. You will also depreciate it on your books, which means the value goes down. So even if you sold it for the same thing that you bought it for, you would have a gain. But we all know that real estate appreciates and it goes on, and nobody likes to pay income tax. We all know that. So when it's time to sell that first building and trade up, what a lot of people do is they go through a Section 1031 exchange, which basically says, I'm selling this building, I'm going to buy this building for $1 more or the same price, and I'm not going to pay any tax right now on the profit from this building. And then there are certain rules about 45 days and 180 days and like kind. And this is not a scenario on Section 1031 exchanges. But so you go from owning this building to this building, and you deferred the gain. So by deferring the gain, you reduce the basis of the assets that you acquired, but you don't pay any tax. And then lots of people do this a second time and a third time. And the way it normally works is by the time they sell the last property, they are going to pay a hell of a lot of money in income taxes. Most of it being capital gains, some of it being something called recapture. I've got a way that if you plan for it, then you're not going to pay tax on any of it, and for a very long time. The rule is that if I own a building and I pass away, I give that building to my heir, say my son. My son gets it at what is known as fair market value. So I've taken this building that, say I only have one building, and I bought the building 25, 30 years ago, and it was worth, I bought it for $1 million, and now it's worth $25 million. And when I pass away and give it to my son, he gets it at $25 million. And nobody pays tax on the difference between 1 million and 25 million. There are certain other things that go along with that. But this has been around for as long as I have been around, and I'm 77. But the thing that you got to realize is no one ever plans for this. The only time I ever heard anyone talk about this was after somebody passed away. I'll tell you a story about a golf course. I was in Santa Barbara, which is 70 miles away from Los Angeles, and a beautiful community. And I had a dear friend who lived there, and I would go up there and I would play golf once in a while. Didn't play well. My best score is 100, but I enjoyed it. And on this day, there were 4 of us, my friend, myself, and 2 of his friends whom I knew. Excuse me. So we start playing, and one of the fellows starts to complain that his dad is very ill, and that they have to sell the dad's house in order to pay medical expenses. So I questioned him over the first couple of holes, and I understood the whole situation. And by the time we made the turn, which is what the 9th hole is called, I came up with a strategy. They needed money to pay the medical bills, and they didn't want to pay the income tax. So I said, why don't you refinance the property? Take out the money that you need for your father's medical expenses. Then we all know your father will pass away within a reasonable amount of time. And when he passes away, you get the property at, and remember these words, fair market value. And you turn around and sell the property, and nobody pays a dime in income taxes. All of that gain is wiped out. I even did it in a much lower level when my parents passed away. So if you plan for something like this, if you have a grandfather, father, son scenario, then it's something that, as long as you know what you're going to do with that last property and you want to grow and do Section 1031 exchanges, you're never going to pay income tax on that property, on the appreciation on that property, or on something called depreciation recapture on that property. Not a dime. Everybody hates to pay income taxes. This is a way that is not one of those really made up things where you have 14 trusts and this one sells it to this one and back. And no, I don't do that stuff. This is where we are using the very basic income tax law. Now, remember something else. I don't know what other assets the person has, just talking like this, and they may be subject to inheritance tax. That's something totally different from what I do. And in every case that I do this, I always bring in an estate and trust attorney who knows what he's doing. He's one of the best, and he knows what he's doing, and he's going to okay the transfer of the property and make sure that it's done correctly. So everybody doesn't want to pay income tax. This is a perfect way not to pay income tax. Guys?
Well, I think, as you pointed out, most people don't like to think about what happens when grandpa passes out of the picture. But I think we all know that we have a duration, and it's a good idea to take that into account when you're dealing with family life, and especially if you want to be sure that your descendants have the best possible experience with whatever investments you've made. So Paul's strategy is spot on, and I really recommend having a look at this if you're looking at commercial real estate. I do believe that there's another topic that we talked about yesterday, Paul, that I'd like to see you bring up. Then it concerns the interest rates.
Didn't I just talk about those a little while ago?
Yeah, you did. You mentioned them, but you didn't go into the depth of what that could mean for a person in terms of, their timeline for investing.
Yes. What Betty is bringing up is there are people who have said, don't buy real estate now. Don't buy it for a while because it's not a good buy. And I don't necessarily believe that. Right now, the interest rates are still fairly high. And being what they are at the moment, the prices for real estate have come down. Because if you have $10,000 a month to spend on a mortgage, if the property value is low, you're going to be spending more on that. No, you're going to be spending more on interest than you are for the property. If the property value is high, which means the interest rates are low, you're going to be spending less on interest and more on the property, which means you can buy something worth more. But now is the time, and the expression, and I'm sure what Betty is referring to, I said, you marry a property, you only date an interest rate. And that marriage on the property, although most marriages don't make it that long, but when you assume that a marriage is for a very long time, you hold on to that property. And that price that you pay for it is etched in stone. And that's like really, really important. But the interest rates are going to change. Now, one thing I didn't mention on the other part that applies in both cases, when the interest rates come down, you can refinance. But the other thing you can do when you refinance is you can take money out. You can get a cash out refinance and take that money out, and that money is tax-free. Gee, I'm talking about a lot of tax-free stuff, but it's all legit. And so when you are in that situation, as the interest rates start to come down, you can refinance, and you can refinance a good number of times. Years ago, back around 1980, I think it was, the interest rates were high, but the lenders charged you points. So say you wanted to do a refinance on a property and your mortgage was $1 million, and the lender would charge you 2 points, $2,000, in order to or 20,000, I'm sorry, in order to refinance. That's like that affects the interest rate, because they can say to you, gee, your interest rate is here, but you have to pay us points. And when you pay the points, all of a sudden the interest rate rises, because it's on the whole package. It's on the whole structure. So look at everything and realize what you are married to as opposed to what you are dating. Look at things and plan. One thing that I thought of about planning for that ultimate transfer to an heir is people have wills. People deal with this situation every single day. But the thing is that nobody talks to the CPA about it. They talk to the attorney, and the attorneys don't know this stuff. So you have to come to someone like me. Now, by the way, I have not given you my contact information, and forgive me. My name is Paul Levine. My telephone number is 818-298-4000. My email address is plevine@lspropertypartnersllc.com. Craig has it streaming on the bottom, but I like to bring it up and say it because now is the time that you might write it down, because now is the time that we're getting into the meat and potatoes part of what you do. Those Section 1031 exchanges that I talked about have rules, and they're not that easy to follow, although they're not that difficult either. So any good commercial realtor, any CPA worth his salt, and a lot of people outside of that realm know what a Section 1031 exchange is and will be glad to help you. But remember, you keep doing it and you keep deferring that gain until that property can be willed to someone who gets it at fair market value, and no one, and I mean no one, pays any income tax. Not talking about inheritance tax. I'm talking about income tax. Anything else?
No, I think that's enough to chew on for today.
Yeah. So that's enough to chew on. And you gave out your contact information, your phone number, and your email, and it's streaming along the bottom.
And you gave that out as well.
Yeah, and that's perfect. And also, You have a book coming out soon, and you can preview it at thebibleofrealestate.info. And then there's going to be more more books.
Yes, there will be a second book and possibly a third book in 2024. The second book will be on cost segregation studies. And let me just add something here. Cost segregation studies give you the opportunity to take massive amounts of depreciation on commercial property that you buy that generates income, and you get a wonderful income tax deduction, and you pay very little in income tax, and therefore you're in the best shape you can be at the time. And if you didn't do a cost segregation study, you would be spreading the depreciation out much longer. My point being that even with these Section 1031 exchanges, you can do cost segregation. You can take a large amount of depreciation at the beginning. You can enhance your cash flow and do all sorts of different things with it. You can, enhance the property you're buying, buy a property next to it, just invest the money in something that may be out there at the moment. Or, as I always like to put the last item, you can take a wonderful vacation to somewhere you've never been with someone you love. The point being, you're never going to pay tax on that amount. You're never going to have to recapture that depreciation and pay income tax on it. And by the way, when your property appreciates, goes up every year, that gets taxed at capital gain rates. And that rate is 20%. When you take depreciation and then upon sale have to go through something called recapture of depreciation, that gets taxed at ordinary income rates. And that could be as high as 37%. You'd be saving all of that income tax by doing what I said, by planning the way we're talking about. Know that people talk about this all the time because people do their wills, as I said before. But you've got to remember to do it, because if you don't remember to do it, you're not going to plan for it, and you're not going to take full advantage of the situation.
Perfect.
Yep.
And I wanted to do this laid back, but when I get going on that stuff, I just,
You don't know laid back, do you?
I know.
Oh,
Laid
I do.
back and Paul Levine in the same sentence. Wait a minute.
No, it
I'm
just
not seeing it.
no, I understand, but these things are so important,
Yeah.
and I mean, you can tell somebody who maybe is in the upper middle class, who invests in some real estate and invests on it long term, and you could have your family pay no income tax, and what else do you want? You would, when you pass on, you want to give the best situation that you can to your heirs. You love them, and that's why you're giving them these assets. But why burden them with income taxes, or why decrease your estate by selling the properties before you pass on, paying the income tax, and then only giving your heirs the residual amount? That's wrong. You don't have to do that. And please, in the event that you're listening to this and it all makes sense to you, give me a call. I'm a commercial realtor. I was a CPA for over 50 years, and I will be more than happy to help you and work with your CPA and your real estate people in order to make this work for you. But remember, I'm also a commercial realtor, and I can help you buy and sell the properties, but that's not part of this.
Yeah, so I think that's
Yeah.
it. The next step is to call you and have a conversation.
Yep.
Yeah. Any last comments, Betty?
I'd say pick up the phone and call Paul. That's
Yeah.
my call to action here.
And I'm available at the moment.
That's right. Call him anytime except when the Green Bay Packers are playing.
No. That's wrong. That's Notre Dame football.
Oh,
Oh,
Notre Dame. Sorry.
Dame. Okay, there we go.
Sorry. I apologize. Yes. I'm not a football gal, so it's in one ear and out the other. But yeah, don't call them during the game.
Yes.
Yeah.
Notre Dame football is sacred in this house.
Okay.
Yes.
Notre Dame. Yeah, don't call during Notre Dame.
Yeah.
Any other time, call.
Yeah.
And please, one thing I do request is call after 10 a.m. Pacific time.
Yeah.
Because I spend my mornings either doing podcasts, listening to podcasts, or going through lots of emails. And by 10 o'clock, everything is pretty much clear. And then
Yeah.
I can definitely pay attention to you.
Awesome.
That's the
Okay.
way.
So on that note, I think we'll let everybody go and enjoy the rest of your day.
You guys as well. Enjoy.
Will do.
It's in the Pacific. It's coming up to lunchtime.
And I will see you next week, same time, same station.
Yeah. Same time, same station.
Be
Yes,
good.
Salut.
Bye-bye.